Mexico, the U.S.'s second largest supplier of goods imports in 2018. Your reaction to those comments from Peter Navarro?
Look, Peter Navarro wouldn't recognize a trade agreement if it fell out of the sky and landed on his head. Peter Navarro does not even begin to comprehend the consequences of what he's advising the president to do and has been advising the president to do for more than 2 years. It's really a seriously dangerous situation that Peter Navarro is advising the president and on CNBC talking about things where he doesn't have a remote clue what he's talking about. The fact is that this move, if the president takes it, will very severely violate NAFTA. It'll basically invalidate the entire agreement because we will be failing to fulfill our most fundamental obligation in the entire 300-page agreement. It also severely violates the World Trade Organization agreements, which comprise a huge portion of all of international law and are critical for global stability. These are the types of consequences you're looking at in the long term for this kind of move.
Matt, to play devil's advocate here, and I'm not saying right or wrong, agree or disagree or anything like that, but you've spent time in the executive branch. You've spent time working on trade policy and trade agreements in the past. When you have a Congress that has been deadlocked over immigration for years and years now, in terms of the laws that are on the books and the unilateral power that is in place for the President of the United States and the executive branch to take some sort of drastic action where something like, say, immigration is occurring, what else is available if not tariffs?
Well, first of all, back when we had presidents who were actually diplomatic, they had good relationships with Mexico and the Mexican government. We share an enormous border with Mexico. Mexico is enormously reliant on our market. And the fact of the matter is that past presidents would have been able to sit down with the Mexicans and would have been able to apply pressure in other ways that didn't severely undermine international law and global security in order to get the Mexicans to fulfill some of their own responsibilities under international law with regard to not allowing this mass migration to America's borders. But President Trump doesn't have those options because he's alienated every one of the United States' closest friends and allies and trading partners, including Mexico. So now these are the only options that President Trump has left. This would not be the situation that any previous American president, Republican or Democrat, would have been in.
Well, Peter, to what degree do you think these tariffs against Mexico are factored in to the market action today? Is 5% fully factored in? And when do we start to see the market factoring in perhaps higher?
Well, obviously, that's very difficult to assess. But I think more broadly, what is important to recognize is that after the most recent recession, really global trade has been a really important part of global growth. And for example, when we look at emerging markets, a lot of productivity gains really came out of emerging markets when really U.S. productivity has been fairly stagnant. So I think the amount of friction that's being created in what is now really a prolonged global trade war is very, very important to recognize. And I'm not sure markets have priced it in fully, especially given in the context of all of the other headwinds I think that markets are facing naturally this late in the economic cycle.
Well, Peter, if that's true, then when do numbers start getting cut?
Well, I think numbers have already been starting to get cut. I mean, if we're talking about earnings, for example, we've already seen a flat first quarter. I often have to chuckle when strategists get on and say earnings for the first quarter were okay. If flat is okay with a market then at 2,900, well, then I guess they are. For the second quarter, earnings are being revised down, and I think margins have likely peaked. And with cost inputs going up because of tariffs, we think margins are going to compress considerably more. Moreover, I think if you look at what the rates markets are telling us, and you look at the correlation between long rates in the U.S. and PMIs, for example, or with ISM, it indicates that while the U.S. is not yet in contraction, that correlation is telling us that it will go into contraction and likely follow the rest of the world. You know, PMI out of China overnight was very weak and back in contraction as we had expected.
Matt, how does this play out and affect and impact the other trade talks afoot for the U.S. right now, most notably in China?
Well, it's President Trump putting himself in a position where the U.S. economy is going to be paying a price if he ends up with 25% tariffs on all goods coming from Mexico, which could happen by October if he doesn't get what he wants. And when the U.S. economy pays a price for that, then Trump is in a weaker position to ask the U.S. economy to continue to pay a price for the cost of the China trade war. One of the things that President Trump's advisors successfully convinced him of not too long ago is that he had to resolve the deadlock over the new NAFTA getting through Congress, because he had to give American farmers relief from Mexico and Canada's retaliation against us for steel and aluminum tariffs. He had to do that in order to maintain his trade war with China, because American agriculture couldn't sustain the cost of both the battle with Canadians and Mexicans over steel and aluminum and the trade war with China at the same time. Trump actually listened to that advice, moved us forward towards resolving the problems with steel and aluminum, Mexico and Canada, but now he's created a new problem with Mexico. And the problem is he can't fight a war on both these fronts. He can't fight trade wars. So he's weakening his position with China by getting into a trade war with Mexico.